All right, today we're putting a company called Southern Company under the microscope. But we're going to do it with a bit of a twist. We're going to analyze its financial data through the eyes of a legend, Warren Buffett, and see if it's the kind of stock you might actually buy.
So the big question for us today is this. How would Warren Buffett's whole investing philosophy size up this business? We're basically going to use his playbook to cut through the noise, look at the hard numbers, and see what story they're really telling us.
So here's our game plan for today. We'll start with the checklist itself. Then we're going to go step by step through the business, its management, its financial health, and of course the price. And then at the end, we'll pull it all together for the final verdict.
At the heart of the Buffett way, it really comes down to four simple but, really powerful checks. First off, do you get the business, and does it actually make money? Second, are the people in charge smart and do they treat shareholders well? Third, is the company financially strong? And finally, are you getting it at a good price? These are the four pillars we're going to build our entire analysis on today.
Okay, so let's jump right into check number one, the business itself. Now, the first thing Buffett always asks is, can I understand this thing? And since Southern Company is a major utility, yeah, it's pretty straightforward. We get it. But here's the real question. Is it consistently profitable?
To put it another way, is the company actually good at turning what it has, its assets, the money shareholders gave it, into cold, hard profit? Because at the end of the day, that's the name of the game, right? Let's see what the data says.
And boom, right away, this gives us our first big clues. We're looking at a return on equity of over 12%, a net profit margin over 15%, and look at that gross profit margin, almost 90%. On the surface, these are some pretty healthy-looking numbers.
Now, let's just zero in on that return on equity, or ROE. This basically tells us that for every dollar of shareholder money in the business, the company makes about 12 cents in profit. A consistent ROE over 10% is often a sign of a really strong business. So for this first check, yeah, Southern Company gets a solid pass.
All right, let's move on to our second check, because it's not enough just to have a good business, right? You need good people running the show. For an investor like Buffett, that means managers who think like owners and who act in the best interests of the people who actually own the company, the shareholders.
So how do we know if management is really shareholder-friendly? Well, one of the clearest signals you can find is a long, steady history of returning cash to the owners. In other words, we're going to take a close look at the dividend history.
And the data here as well, it's pretty impressive. 25 straight years of dividend increases. Think about that. That's a quarter century where management has consistently said, we're going to give more cash back to our shareholders. It's tough to argue with a track record like that.
So, based on this history, it looks like the company passes the management check with flying colors. But this is where our investigation is about to take a pretty interesting turn. That long dividend history is fantastic, but it's only good if the company is healthy enough to actually support it. And that's where a potential red flag starts to pop up.
Which brings us right to check number 3, financial health. This is where we shift from looking at the past to looking at the company's ability to handle trouble right now. Is this business built on a foundation of solid rock, or is it on some pretty shaky ground?
And here's the critical question. Can the company actually afford its day-to-day operations and that fantastic dividend we were just praising? Because, a promise to pay shareholders is only as good as the cash you have to back it up.
And right away, this slide paints a very, very different picture. We're seeing negative free cash flow, which means more cash is going out than coming in. We see a high debt-to-equity ratio, which tells us it's relying a lot on borrowing. And the current ratio is below 1, which can be a warning sign for short-term trouble. Let's dig into these.
This is the number that just jumps right off the page. Negative $2.9 billion in free cash flow. To put it simply, after paying for all its operations and investments over the last year, the company had a massive cash shortfall. That is just not a situation you can keep up for long. And the picture gets a little more concerning. A debt-to-equity ratio over 2 means the company has twice as much debt as it has shareholder equity. Now, utilities often carry a lot of debt, but this level of borrowing adds a lot of risk, especially when your cash flow is negative. This part of the checklist is flashing some bright red warning lights.
So, we've got a profitable business with shareholder-friendly managers, but some really serious financial concerns. Now, for the final, and maybe the most important check in the Buffett playbook, the price. Is it a good deal? After all, even the best company in the world is about investment if you pay too much for it.
The key idea here is what's called the margin of safety. Just think of it like a safety cushion. You want to buy something for way less than what you think it's actually worth. That buffer protects you if you're wrong, or if the company hits a rough patch.
So what's the data say about Southern Company's margin of safety? Well, on the left, you've got the current stock price, over $93. And on the right, you have one estimate of its fair value, based on its profits, and that's down around $64. You can probably already see where this is going.
This just makes the problem crystal clear. The margin of safety isn't just small, it's negative 45%. According to this model, the stock isn't on sale. You're paying a huge premium for it. There's no safety cushion here. You're paying way more than this model says it's worth. On this final check, it's a major fail. Okay, we've run through all 4 checks. We've looked at the business, the management, the financials, and the price. Now it's time to pull it all together for the final verdict. Based on this data, does Southern Company really look like a classic Buffett-style investment? So let's just summarize what we found. On the plus side, you've got a profitable business and an amazing 25-year track record of rewarding its owners. But the negatives? They're pretty serious. The company is burning through cash, it's carrying a ton of debt, and the stock looks really expensive.
And that really gets to the heart of the problem here, doesn't it? The data is telling us 2 completely different stories. The story of the past is of a high-quality, reliable company, but the story of the present is about a financially risky and expensive one.
And that leaves us with this one big final question. When you're looking at an investment, how much does a celebrated past matter when the present is flashing so many warning signs? Is a great history enough to make you overlook a potentially risky financial future? The data gives us all the pieces, but how you put them together, well, that's the art of investing.